Right, so people have been requesting a video showing you how to trade short contracts, or basically how to open with a short contract. So this is the video, this is what this video is going to demonstrate. Now fundamentally, if you look at it, it's exactly the same thing. We're still going to be trading the dollar pound, we're still going to be trading with the same initial margin, the same maintenance margin, same face value, max contracts is still the same, and let's say we're still going to maintain it at 40 contracts opening, okay? So in which case we can now work out our initial margin, which is this. We can now work out our maintenance margin, which is this. Okay, so those values don't actually change. Straight away, you should know that your margin account is 40 multiplied by this. So in which case, you now know your margin account. So what's the date today? The date's the 4th of December. Yep, and, well, if we go into CME website, so here, CME group, yep, market data, delayed quotes, FX, we are still trading pound dollar. Okay, we are still looking at December 2013 options, 1345. So, okay, 1.6345. Okay, so that is our opening position, opening, direction, short. Okay, once you've done this, before we do that, let's work out a commission. 40 contracts multiplied by 25 gives us 1,000. Okay, same thing with a bank statement as well. 4th of December. Okay, details, cash in, capital. Cash in will be 25,000. Cash out 0. Balance will therefore be the cash in minus the cash out. Okay, at the same time, 4th of December, short, dollar pound, 40 contracts. Okay, so that's what we have. Cash in none, cash out will be 66, and therefore the balance will be the cash we had before, plus whatever cash in, minus whatever cash out. So that's how much it cost us to buy those 40 contracts short. Okay? So, you set up your portfolio in exactly the same way. The only difference is that you've gone short here. Now, say for example, it's the date, it's the 4th of December, so it's today. Okay? We can still settle. We still need to track. We need to track our settlement price, and just so happens that if we take, for example, our settlement now price is now 1.62434. We're still in our opening position. We are still short, but we can now work out our profit and loss. And how do we work this out? The only difference in the profit and loss formula is you start off with a minus. Open bracket. Yep. New price minus old price multiplied by face value multiplied by number of contracts, and that gives you your profit and loss for the day, which will then be added to the margin account. Okay, the same rules pertaining to top up also relate to when you go short. So for example, if your margin account falls below 60,000, then you still have to top it up by, you still have to top it back up to $60,000, and the same principles apply and the same processes apply as if you had gone long. You would have to take that money out the bank account and put it back into your margin account. So that's the settlement price for the 4th of December. Let's say on the 5th of December, settlement price is now 1.6240. Say for example that's what happened. We are still open in this trade. Our direction is still short. We can now work out our profit and loss for the 5th of December. So equals, once again, the only thing that changes is the minus sign. New price minus old price multiplied by face value multiplied by number of contracts, and that gives us minus 1,500. So work that out again. We now pay, that now comes out our margin account. So 6th of December, let's say we hold it till the 7th. Okay, it's still going up, 625. Okay. Once again, we can work out our profit and loss, new price minus old price, multiplied by face value, multiplied by number of contracts, minus, we made another loss. Okay, so 7th of December, we decide that it is now time to sell. Okay, so we go back onto CME website, and we're now looking once again at our last price. We're now looking at this price right here because we're closing our post. Okay, so let's say the last price in this case was 1.63. Okay, so it's gone up again. It's now a closing trade, and exact opposite. We've gone short initially, so now we go long to close our position. 40 contracts again. So let's work out our profit. Minus new price minus old price multiplied by face value, multiplied by number of contracts, and that gives us a loss of that. Okay, we worked out that that's our margin account. So now that we've closed our account, we can then transfer whatever's in our margin account back into the bank statement. So this is 7th of December, so 07. Okay, closing. Long, $pound, 40 contracts. Okay, so in which case you're transferring this 77,250 back into your cash. 77,250 back into your bank statement. No cash out because you haven't paid anything. Equals this plus this minus this. Okay. Now I've made a small mistake here in the sense that I haven't added commission to the initial one. So all I'm just going to go back into is just take that and confirm that to 67 because I have to add the commission from before. And that's how you go before. On top of that, I can clean this up slightly, so just to let myself know, opening. Yep, and this is a closing trade. Okay, so I know what each trade was for. Okay, and that's it. That's how you trade short contracts. Exactly the same thing. The only thing that changes would be the calculation of profit and loss. You just add a minus to the start of the formula, and that's about it. Okay?